Hello, good evening, and a very warm welcome to today's session. This is the first edition of the BFSI series, and we will be kicking off today with our trainer, Mr. Muhammad Ali. He's from the State Bank of Pakistan. He works in the development finance, and he has been associated with the central bank for around 8 years. He is an ACCA member and a very intellectual individual. So, as I can see that we have crossed a bit time, and this is going to be a lengthy session. So let's just jump into it, and I'll be sharing my screen, Ali, and you can kick off.
Yeah, sure. Hello, everybody. This is Muhammad Ali. I'm working for the State Bank of Pakistan for the last 8 years. And, as part of this Powerhouse session for the bankers to build capacity of our banking fraternity, especially for the ACC members working in the banking fraternity. The ACC of Pakistan has organized this program. As part of this program, the first session is about introduction to the banking regulations in the country. So I'll be taking you through it. I have designed the presentation in this regard so that it is easier for you to go along, because prudential regulations or regulations, as we call them, can be very boring. So we might lose track of them. So I've tried to make sure that I've formulated a very brief and interesting presentation. When I start, I'd like to know whether we have any bankers part of this audience. If anybody would like to inform that he or she is from a bank in Pakistan or abroad. Anybody? Okay, we'll wait for responses as they come. If anybody would want to inform whether they're working for any organization other than a bank, if somebody is working for an organization other than a bank. Okay, we'll wait for the responses as they come. I would start my presentation, and we would try and make sure that we take your questions. You can write your questions down in the comments section. So as and when I get a chance, I'll try and address them. So banking regulations for banks in Pakistan. This is our topic today. Before I start, I'd like to add a few points. Whether you're working in any kind of field, whether it's the banking industry or you're working for a corporation or an SME, it's important that you know the regulations that are connected to your work. And then, if you're working for an SME or a corporate house, or you're running your own business, it's important that you know the regulations. And then it's even more important to know the regulations connected to your type of business, because you need finance, and you have to, at the end of the day, approach a bank to secure finances from them. So it's important that you know the regulations of the banking sector in our country, so that you're better prepared to approach a bank. And for instance, bank would not lend to an organization that does not prepare its financial statements. It will be very reluctant to lend to such an organization that does not have the books to show its financials. So if you would know this regulation or this kind of prudential regulation, that banks would require what you call as your financial statements, your books. So you'd be prepared, you'd make sure that you advise your own business or the business you're working for, that they should prepare their books before you approach a bank. So the idea of the ACCA Pakistan to start this session is mainly to build capacity of the bankers and also to build capacity of the ACCA members, whether they're working within a bank or outside the bank, to make sure that they are well prepared to approach a bank and are well prepared to secure the much needed finances for themselves or for their businesses. So we move forward to our next slide. Feroz, could you move to the next slide, please? Feroz. Yeah, this is my introduction. I'm an ACCN member. I'm working as an assistant director at the SVP BSc Bank Multan. I'm working in the development finance division where we work to ensure that the commercial banks are extending enough finances to priority sectors. So we work throughout the year. Most of our work involves working closely with the banks and monitoring their progress with regards to the targets that the central bank has assigned to them. I'm also an ACCA Urdu mentor. I am a freelance writer. I write for different subjects, and I'm also becoming a lawyer. This is my email address and my contact number. Next slide, please, Rose. Feroz, can you move to the next slide, please?
There's a bit delay in the transition of slides, so you'll have to. Are we on the fourth slide?
Yeah, fourth slide, please. Yeah. So first of all, it's important wherever you work, as bankers, like I said, you need to know the kind of documents that you need to refer, the kind of instructions you need to refer. You need to know all your resources, that where all your regulations, all your instructions, all your standard operating procedures, SOPs as we call them, are coming from. So before we start on to the actual regulations or the prudential regulations as we call them, it's important we understand the banking regulation landscape in the country. The first important thing to know here is that, just give me a sec. The first important thing to note here is the Basel Accord. Now, Basel Accord is basically it's a committee about bank supervision. What they do is they come together and they try and make sure that the banking industry is ready enough because they issue different kinds of guidelines, and they try and make sure that the banking industry in the entire world is ready enough to face different kinds of risks. For example, capital risk, for example, the market risk, for example, operational risks. Now, this has become more and more important as the world or the global financial world has seen different collapses at different times. The most recent one has been in the year 2008. It has been one of the biggest financial crises that the world has ever seen, where the US's taxpayer had to pay about $700 to $800 billion to bail out the banks or the banking industry as a whole. Similarly, the banking industry in the UK had to pay about £40 billion to bail out their banking industry. Only because of the faults made by the bankers in the US and the UK. It is because of this that the Basel Committee came together and they formulated a set of guidelines or a set of agreements that are now called as Basel III. The purpose of Basel III is to make sure that the banks are being regulated or they are following the kinds of guidelines where they are very much ready to face any kinds of capital risk, market risk, or operational risk, especially market and the capital risk. For example, if a bank was to fail, then it would be important for the regulator in that country or in that economy that the banks have with the regulator placed a certain amount of money so that if the bank fails, the regulator can intervene and make payments to the people who have deposited the money in the banking sector in that particular bank. Now, if that was not to happen, it would be very easy for the bankers to simply fail, for the banks to fail, and not return any money to the depositors. Now, that is where the role of the regulator comes in. The regulator makes sure that the banks places certain amounts of money in the form of tier 2 capital. I'll tell you what tier 2 is as we go along. In the form of capital with the bank, it is the kind of capital that those banks cannot touch until and unless there is a change in the guidelines. And basically, being the latest guideline, Pakistan has adopted Basel III. We are going towards Basel IV as well, but Basel IV is in the works. Basel III is something that has been finalized. And SVP has worked on ensuring that the banking sector in Pakistan adopts Basel III. So it will be important for the participants to know what Basel III is. What Basel Accord is, like I've said, it is a committee of bankers that formulates different agreements that are implemented throughout the world to ensure that the banking sector is ready to face capital, market, and operational risk. So Basel III.
Ali, can I pause you for a minute? Can I pause you for a minute?
Yes, sure. Yeah.
There's a sort of distortion. The participants are complaining.
Okay.
Can we improvise? Let me suggest you.
Like I can come on the phone. I can come on the mobile phone.
Yeah, you can just join from your phone and unmute yourself.
On the phone, yeah?
Yeah.
Okay, give me a second.
Just hold on a minute, guys. We're gonna get this sorted. Let's try that, Ali. Until Ali is sorting this issue, I would like to tell you all that there are some handouts uploaded in the handout section of the control panel. It contains yesterday's presentations by Narayanan and Steve, along with the recording links file. That file contains the Google Drive link, which contains all the material that would be used in these webinars, or it had been used in these webinars. So you guys can access that file access the Google Drive and fetch anything that you would like to. The recording links file name is BFSI recording links Powerhouse. Lee, would you like to unmute yourself and try again? You're on self mute.
Hello?
I think you have unmuted from your laptop again.
You did.
So now is it better? Am I back on? Can you guys hear me?
Yes, it's better.
Hello?
Yes, Ali?
No, I can't hear you. Can you guys hear me?
Yes, we can.
Say hello. Can you hear me?
Yes, Ali, it's better. The participants are saying the
Okay, I think you
voices.
guys can hear me. If somebody can message me, uh, that'll be good. Okay, so I've got the message that you guys can hear me. So we were basically on the banking regulation landscape in Pakistan. I've explained to you the concept of Basel. Basel is basically a committee. You call the committee Basel Committee on Bank Supervision. Now, it is a global community that issues a set of guidelines, a set of guidelines to be followed by banking industries in different countries. Now, Pakistan as a country has adopted Basel III. So what we've done is, our regulator has done is, it has ensured that the banking sector in Pakistan moves ahead, moves a little further, and adopts the most latest set of guidelines issued by the Basel Committee. Now, as we go along, as we go forward, I'll tell you what Basel III actually is, what it constitutes. Now, another part of our banking regulation landscape in Pakistan is the regulator, the State Bank of Pakistan. We call it the regulator. Now, what it does is it issues all the policies and guidelines that are to be followed by the entire banking industry in the country. Now, if certain banks do not follow those instructions, there are different teams. There is an entire inspection department that is conducting both off-site supervision or inspection of the banks, and is also conducting on-site inspection and supervision of the banks. So that banking inspection department, as we call it, BID, that goes to different banks and inspects um, the entire functions of the banks and whatever they've done throughout a certain period of time. And if they are compliant, if they are non-compliant, and then the BID department, or the department that is inspecting the matters of the banks, would issue penalties to the banks. Those penalties can be hefty in terms of financial value. So it is important for the banks to remain compliant. So the State Bank of Pakistan, as a regulator, sets out all the policies that the banks have got to follow. The actual department that works on formulating these policies, instructions for the banks, is the Banking Policy and Regulation Department. Now, BID, as I've told you, the Banking Inspection Department, is a part of this BPRD. Like I've said again, the BPRD, and it's got different inspection units or teams or departments that is conducting both off-site and on-site supervision of the functions of the banks. Now, how off-site? I'll give you an example of the off-site uh, uh, supervision. For example, there is a system called ITRS, International Transaction Reporting System. Now, what banks do is they report all the money that is coming into the country against exports in that ITRS, or they report all the money that is going out of the country in that ITRS, like I've said. Now, that data is available to the Banking Policy and Regulation Department, to the banking inspection teams, or the off-site supervision teams sitting in SBP. Now they keep conducting those off-site supervisions. Where they find an anomaly, they would take that up with the bank, and if the bank is not able to, satisfy the regulator, it would end up in different kinds of punitive action, both financial and non-financial. So I again come back to my point that as ACCA members, whether we work for a bank or we work for a corporate house, or we're running our own business, it's important that we are aware of the regulations conducting to the banking sector in the country, because at the end of the day, it is the finances that a business needs. So we need to be very much ready as to how we are to approach a bank. So for that, we need to know the regulations. Now, I'll sum up the landscape, the regulation landscape in Pakistan. It is the Basel III that we are following. SBP has formulated regulations that are based on Basel III. SBP itself is the regulator. BPRD is the department that is basically formulating the policy and implementing the policy. And it is also conducting the off-site and on-site supervision of the banks, and is conducting punitive action against the banks if they are non-compliant. Feroz, can we move on to the next slide, please? Now, like I said, what is Basel Accord? Basel Accord, again, it is a committee and that comes up with different kinds of regulations that it expects to expect different jurisdictions in the world to adopt, so that the banking sector as a whole remains ready to counter any kinds of market, capital, and operational risk, so that financial failures of the likes of 2008 do not recur, and the trust of the general public remains intact in the financial system of any particular country. Next slide, please. Now, there have been three different sets of guidelines: Basel 1, Basel 2, and Basel 3. Now, Basel 3 is the latest one. Basel 1 and 2 are not relevant anymore. three kinds of risks that Basel Accord or the Basel um, uh, Committee Committee on Bank Supervision tries and make recommendations about are capital risk, market risk, and operational risk. Next slide, please. Now I've summarized the different kinds of Basel's, the kind of agreements or the kind of recommendations that the Basel Accord made over the years. The first one was Basel I. What Basel I did was it categorized the assets of the financial institutions into five different categories. Um, and the weightage that it gave to different risk categories was from 0% to 100%. Now, this isn't something that is of value to you as of now. So it can be a matter of, it can be something that you guys can think of knowing that what Basel I at that point in time did. What is more important at this point in time for you guys, or more relevant for you guys, is Basel III. So at the point of Basel I, what Basel I did was it categorized the assets of a financial institution based on five different risk categories, and it gave percentages, risk percentages to those risk categories. Now, the next thing that Basel I did was the minimum capital requirement. Now, what is a capital? Capital is basically the money that a bank invests or its shareholders pool together when a bank starts its operations. Now, when a bank starts its operations, um, as we all see, that there's so many people that are going into a bank, they're depositing money in the savings account. We have current accounts and all sorts of different kinds of financial instruments that banks are handling. So it is once the bank has a license, it is different kinds of people who come in and they start putting money in the bank. Now, but the one thing that is very important is that uh, what the regulator does is it makes sure that a certain percentage of capital is put aside with the regulator, uh, so that if a bank was to fail, or if a bank was to get to a point where there's a bank run, or where there's a negative news about a certain bank, and people were to panic and rush towards the bank to take their money out, bank had a certain amount of money as cushion that it could use to pay those people who are panicked. Now, what that does is, in case of a panic situation, bank has enough money set aside to cover such a risk. Now, a decade ago, one of the probably more than 10 years ago, one of our governors, he was sitting in a news interview, and he happened to pass a comment about a certain bank uh, and its financial health. That one comment made people to start panicking and rushing towards the bank to take the money out. Now, if this cushion was not available, that bank would have failed. And when one bank fails in a financial sector or in a country, it leads to the failure of other banks, because we are connected. All the banks are connected. Different banks have lent money to other banks or other financial institutions. So if one bank fails, there is a chance that that failure would pass on to the next bank, and then that would lead to a failure of more than one financial institution. So what it would do is it would give rise to systematic risk, which can be any financial institution that needs to get licensed would need to make sure that it has 8% capital in terms of tier 1 and tier 2, 8% of the risk weighted assets. Now, what are the risk weighted assets? Just give me a sec, I'll tell you about the risk weighted assets. Okay, I'll share this definition as we go along. Um, I've put it aside. I'll share that in detail. So 8% of the RWA, or the risk-weighted assets of a bank. Now, this is what Basel 1 did. Minimum capital requirement of the tier 1 or tier 2 type of capital. Now, tier 1 is basically the capital that the shareholders invest in the bank when they start a bank. And tier 2 is basically tier 2 is not the kind of shareholding. It is basically the kinds of investments that the banks are required to keep with the what you call as um, with the regulator. For example, if we talk of Bank of Law, when Bank of Law started its operations, its shareholders would have come together and put together a certain amount of money. Now that capital is known as tier 1 capital. And tier 2 capital is basically the amount of money that the bank would then be required to keep with the central bank as a buffer. We call that tier 2. That is one example of a tier 2 capital. There are other examples as well. So I'd quote other examples as we go along. Now Basel 2. Now this has evolved. All those agreements, all those guidelines have evolved over the years. Now we come to Basel 2. What Basel 2 did was it focused on 3 key areas. Minimum capital requirements, that was done by Basel 1 as well. But now 2 more things were added. One was supervisory review and internal assessment. What Basel 2 or the guidelines or the recommendations made by Basel 2 was that banks need to make sure that their internal assessment processes are very strong. They're in place and they are strong to make sure that they are able to assess any risks that the banks might face over the coming years. Yeah. And supervisory review. Now, what supervisory review is that the regulator would come in and start supervising different processes and different steps taken by the banks. You know, the regulator would not only be a regulator, but it would also be a supervisor. It would supervise different steps taken by the banks. For example, if we talk of the COVID, during the times of COVID, banks started to face financial difficulties. Now the regulator chipped in and it started to make sure that the regulations that were in place were made more easy for the banks. For example, like we've spoken about the minimum capital requirement, that was decreased from 12.5% to 11.5%. It made easier for the banks to operate in that environment. So a regulator not only has a regulator's role where it is regulating the banking industry, but it is also supervising the entire banking industry. For example, when a bank or the entire banking industry faces a situation, the regulator jumps in and makes sure that the entire banking industry, or if it is a single bank, it comes out of that situation successful. So the second thing introduced by the Basel II was the supervisory review and internal assessment process. And the third thing is the effective use of disclosures. Now we are all accountants, professional accountants, and we know what disclosures are. Disclosures are basically the information that we disclose as part of our notes to the financial statements. Now, what Basel II did was it made sure that it issued recommendations for the banking institutions to start ensuring enhanced disclosures, so that not only the bank itself, the regulator, and the other users of the financial statements of the banking industry are able to know what's coming next, so that they can take corrective measures accordingly. Now, I asked 2 questions when I started the session. Do we have any bankers as participants? Can anybody tell me if we have a banker as a participant? Feroz, do we have somebody commenting, or can we find out if there are any bankers in our set of students
Yes,
or in our audience?
yes, we have. There are people from HBL. We have an auditor from a bank working on CR disclosure, MBL. We have a couple of bankers.
Okay, we'll move forward. The next thing that Basel II did was it introduced another class of capital that we call as a tier 3 capital. Now, again, like I said, it is a matter of history. You guys should know this as a matter of history because tier 3 has again been taken out by Basel III. Tier 3 was a kind of a capital that was more substandard as compared to tier 1 and tier 2. Tier 1 is basically classified as tier 1 because it is basically related to the shareholders as closely as possible. So shareholders would be able to access this capital as and when needed. Tier 2 is basically classed as second because it is not accessible. The shareholders are not able to access this kind of capital, so we call it tier 2. Tier 3 is the kind of capital that is not connected to the shareholders. It probably is the different kinds of loans or amounts that have been deposited in the bank or things that the bank have. Yeah, we've got some comments.
For your ease, I included the answers here as well. There are some questions coming up, but we will take a break in a later time and then answer these questions.
I'm not able. Just give me a sec. Rose, I'll give you a call. Yeah. So yes, we'll assume again. Basel II, what Basel II did was it focused on three areas: minimum capital requirements. Basel I was doing that as well. It didn't change the minimum capital requirement. Then it introduced the supervisory review and internal assessment process, enhanced the role of the bank itself and the regulator, and it made sure that banks were encouraged to disclose as much or enhanced information to the users of its financial statements. And then it categorized the regulatory capital into three different types: tier 1, tier 2, and tier 3. Tier 3 has since been discontinued as part of Basel 3. Now we come to Basel 3. Basel 3 is something that Pakistan has adopted and our banking industry has adopted. There may be some areas that might not have been adopted, but most of Basel 3 areas or most important parts of Basel 3 have been adopted by the banking industry of Pakistan. Now, the first thing that it did was it enhanced the minimum capital and liquidity requirements from 8% to about 13%. So that is 10.5% and 2.5%. Now, 10.5% is the minimum capital requirement, and 2.5% is the minimum liquidity requirement that all the banks in Pakistan are required to ensure. This 2.5 was reduced, as I said, to what you call as 1.5% when COVID came in. Um, um, so the banks were not required to maintain the liquidity requirements at 2.5%. The next thing the Basel III did was enhanced supervisory review process for risk management and capital planning. So what the State Bank is now required to do is make sure that it closely monitors the risks faced by banks and the kinds of capital planning they have in place, not only at that point in time, but also considering the future. So now what Basel III has done is it has made sure that the banks have become more forward thinking. So if there are expectations that situations or the capital landscape of the bank would change over the coming years, the bank would be required to take different measures at this point in time, so that if an untoward situation is predicted in the future, it does not come to that point. And what it did, the third thing it did was it enhanced the risk disclosure and market discipline. Now, here again, the role of the regulator came in place because market discipline has to be ensured by the regulator. Now, what the regulator has done is it has enhanced the kinds of punitive regimes that are in place. For example, if we talk of the operations of the banks, one operation of the bank is to ensure the flow of cash in the economy. Now I as a consumer would go on an ATM, put my ATM card in the machine, and money would come out. What I would want as a consumer is to um, is to is to have cash that is clean, which I can carry in my pocket, and I can give it to my kids. It is not dirty cash. Now, one of the functions of the central bank is to inspect the quality of the cash that these banks are putting out to the market. About 4 to 5 years ago, the punitive regime or the fines that were connected to banks allowing flow of substandard currency into the economy were not as hefty as they are today. So the fines have been revised. So now, if an inspection team of the regulator goes into a branch and comes to know that um, the bank is involved in pushing of substandard note in the economy, and the fines are hefty. So market discipline. What regulator is doing is it is ensuring market discipline, not only in terms of the capital requirements, but also in terms of how banks are ready, are future ready, or how they are behaving in terms of their operations, their risk management, and their corporate governance. So this is the entire Basel Accord and how it has evolved over time from Basel 1 to Basel 3. What we as we as a class, or the kind of interaction we are in, we as an audience need to know here is what is the which Basel Accord are we following right now? We are following Basel 3, and our banks are required to ensure minimum capital and liquidity requirements of about 13%, which were reduced by 1% during the times of COVID. It is because of the adoption of Basel III that the role of the bank's internal management and the regulator has increased, and we've tried to make sure that banks are more future ready in terms of their risk management and in terms of the market discipline they have. So this was basically the Basel Accord. Can we move on to the next slide, please, Firoz? Yes. Of course, Basel 3 is relevant to our scenario. So I've included the slide that is more um, more relevant to the task or to the area. Like I've said, it is a set of recommendations that are issued by the relevant committee. Um, um, what they do by issuing these recommendations is they try and reform the banking sector. They try and strengthen the banking sector in terms of the regulation, in terms of the supervision, and in terms of the risk management. Now, why do they try and do so? Because uh, um, what we as bankers or the banking industry or as regulator or as parts of the financial sector would want to make sure that the masses they have the trust in the financial sector, so that they are ready to put their money, they are ready to deposit their money in the banks, and not the other way around. They're not trying to take, they're not trying to think that banks are untrustworthy, or if they deposit their money in a bank, it would be stolen somehow, or it would lead to some misadventure by an executive of a bank. So what Basel III has done, it has reformed the banking industry. It has tried to strengthen the banking industry in terms of regulation, in terms of supervision, and in terms of risk management. Risk management would only be better when the regulation and the supervision part is in place, and it is actively in place, and it is being implemented in letter and spirit. For example, I'll give you one more example. Whenever there is a takeover of a bank, or if a bank wants to sell its stake to another um, 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 another um, another stakeholder or another business person or a business group, it has to go through the regulator. The regulator makes sure that the bank that is being sold to another group or another business empire, uh, uh, the regulator tries and makes sure that the buying party or the buying institution is uh, yeah, we're back to the slide now. Yeah. So whenever there is a bank wants to sell on to another, or the owners of a bank want to sell to another owners or another buyers of that bank, the entire sale and buyout of the bank goes under the supervision of the State Bank of Pakistan. For instance, now in the works is the sale of Summit Bank, and the interested party is the Fatma Group that is based in Lahore. The entire process is being supervised closely by the State Bank of Pakistan. It will first be authorized by the regulator, then only the sale of the bank can take place. Otherwise, the sale cannot take place. Because what the regulator does is it makes sure that the party buying the stake in the bank or the entire bank is in a position to run the affairs of the bank going forward. Because like I said previously, that all the banking sector is very much closely connected. So if one bank was to fail, it could lead to systematic risk. What is the systematic risk? That one bank could lead to the failure of the next bank, and the next bank could lead to the failure of, say, 3 4 more banks, and eventually could lead to the failure of the entire banking sector in the country. So the regulator chips in and makes sure that any kinds of sale and purchase of a banking institution are supervised properly, so that the interest in the banking sector passes on to a capable business group, so that any kinds of future risks, including systematic risk, are avoided. Now, this is based on 3 pillars: enhanced minimum capital and liquidity requirements. We've read that previously. Enhanced supervisory review process, enhanced risk management and capital planning, and enhanced disclosures and discipline. It will be important. Like I've said here, there are so many things that I might miss as part of this lecture or as part of this interaction. it is important for you guys or for the audience. We would share um, a set of resources that you guys would need to read or go through if you want to familiarize yourself entirely with the regulation framework of the country. In that, you have most of the guidelines would be available with the regulator, with the State Bank of Pakistan. But what I've done is I have brought all these guidelines together in the form of a document, in the form of a folder. I'd share it with Firoz, and Firoz would probably share with the audience. Now, here again, I reiterate that it is important that we, as part of the professional accounting fraternity, as part of the banking industry, as part of the non-banking industry, that we keep ourselves connected with different updates that take place with regards to regulations that are imposed on banks, so that we are more ready to interact with these banks. For example, now I represent the development finance institutions. Different SMEs or different representatives of the SMEs come to us and complain that the bank is not ready to lend to us. But when we approach the relevant bank and take the complaint of the representative of the SME to that particular bank, the bank tells us that certain matter related to that SME is not clear, so they cannot lend to that particular SME. Now the SME is complaining because the SME is not ready enough, because it does not know the regulations that are in place. It is because of this they complain. But when we brief them that, look, this is a particular requirement that is in place by the State Bank of Pakistan, and you would have to meet this requirement, only then that representative of SME understands and tries and goes back and tries to improve the that particular part of his organization, so that when he approaches the bank next time, he's more ready and he's more what you call as acceptable by the financial institution. Now, in this respect, State Bank of Pakistan has launched the concept of SME clinic. What we've done as part of the clinics is we bring in the SMEs and we try and organize or train them to the extent, or we try and make them aware to the extent that they know how they need to ready themselves before they approach a bank to secure financing. So again, I reiterate, or I put my point forward, that we as professional accountants, part of the banking sector, part of the non-banking sector, need to make sure that which kind of resources we need to be aware of, or we need to consult before we take our organization for an interaction with a bank to secure financing, or we advise a client. And of course, look, professional accountants are in the business of consultancy and advisory as well. As part of this session, and once we've conducted this session, I'm pretty much sure that you guys would be in a better position to advise your own employer or an SME that approaches you for advice on securing financing from banks. Firoz, next slide, please. Okay, Firoz has messaged me that we should take a namaz break. Firoz, how long should be the namaz break? Okay, we'll take a break until 7:15, and then we'll come back and restart from here. Now you guys can make your questions ready, and we'll try and take some time out at the end of the session to address those questions. Thank you. I'll see you back at 7:15, please. Hello? 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 All right, fellows, I'm back. I hope everybody else is back as well. Just give me a sec. So yes, I've set the scene with the explaining the regulatory framework or the regulatory landscape of the banking industry in Pakistan. I have told you about Basel III. Now, one thing that I'd like to re-mention or mention again is the minimum capital requirements. Now, as more and more deposits come into the bank or are added to the bank's tally, uh, the the amount of money that the bank needs to keep with the regulator increases as well. So, for example, if the depositors had deposited about $100 million or 100 million rupees in a particular bank, it would need to keep 12.5% of that amount. That will be about 12.5 million rupees with the regulator. But if this amount of deposits with the bank increased to 200 million, its minimum capital requirement would also increase to 25 million rupees. So this is the idea that more and more deposits that a bank is able to mobilize, more and more money that it will need to set aside with the regulator to cover those deposits. Now we move on to the prudential regulations. What are prudential regulations? As the word expresses itself, prudent. These regulations are prudent in a sense that they make sure that banks are carrying out operations in a manner uh, that are uh, uh, that are going to lead to results that are positive and that are going to help avoid results that are negative. Now, one of the most important functions that the banks perform is lending money. Because look, where does a bank earn its money from? It accepts deposits from the customers and it lends money to the people who are looking to borrow from the bank. So, for example, if a bank accepts deposits of $100 million and its cost is about 10%, and if it lends about that $100 million onto the what you call as to the borrowers, it would charge about 15%. So the 5%, the difference between the amount at which it is lending the money and the amount at which it is um, paying to the depositors is its spread. So that is where the bank earns its money from. So in this example, it will be important that if a bank accepts deposits of 100 million rupees, it can only lend about 88.5 billion rupees because the sorry 87.5 million rupees because remaining 12.5 million rupees would need to be deposited with the State Bank of Pakistan. So one of the main functions of the banks is to lend money. That is where they earn all their money from, so they can get carried away. Banks can start lending to organizations, to consumers, to SMEs in an aggressive manner, aggressive to the extent that they might start losing money or those loans might go bad. So when loans would start going bad and bank would not be able to earn money, it would not be able to pay back the depositors, not only their return but also the actual amount of money. So it would lead to problems. So this is where the State Bank chips in and has issued prudential regulations um, uh, for the banks to follow when they're lending to different kinds of sectors or different sections of the society. Next slide, Feroz, please. So the BPRD, like I previously mentioned, has issued prudential regulations on 7 different areas. One of the biggest functions that the banks are performing is to provide credit Hello? Hello? It is the big corporate houses, it is the big groups that the State Bank has issued prudential regulations for. Next, the State Bank has issued prudential regulations for SME financing, the small businesses, agriculture financing, the agriculture sector. It employs about 60% of our workforce. Then you've got different consumer areas as well. For example, consumer financing, for instance, we buy cars through the banks. We are buying other, for example, we buy a bike, it's our credit cards or personal loans. Similarly, housing finance, the State Bank had introduced a low-cost housing scheme recently that quite a few people availed. Now, that was a type of consumer financing as well. State Bank has issued PRs for housing finance, for consumer finance. And then we've got bigger projects where banks pool in money to finance large projects. For example, be it the construction of a large road, or be it the construction of, say, a hospital, or be it the construction of a large a mega project being initiated by the government of Pakistan. Similarly, microfinance banks, it is the smaller banks that operate in our country, and they are lending money to the most poor segments of the society. So what State Bank is doing is it is issuing prudential regulations for different segments of the economy. The most important one of these is the corporate commercial, because it is the bigger groups. So there is a fear that banks would find it easy to lend only to these bigger corporate houses. Because look, if I had 100 million rupees and I had the opportunity to lend to say 5 big groups, I lend all the money to the 5 big groups, sit on my sofa and earn money. Now, I would not have to go into the hassle of lending to farmers who are working in fields and who do not know how to interact and work with the banks. Similarly, I would, as a banker, would not want to come out of my comfort and start lending to SMEs that are not ready, that do not have the financials, the books to represent to the banks. And so I would not want to lend to these segments. I prefer to lend to the corporate commercial segment of the economy, and find it easy to earn more and more money. But this is where State Bank's role, or the regulator's role, comes in. It makes sure that by issuing the prudential regulations, it is ensuring that banks lend to the corporate and the commercial sector up to a certain limit, and also they lend to the corporate commercial sector in the most prudent manner, where their financing is not concentrated to only a certain number of uh, 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 corporate houses or corporate groups, but the money is spread out in a fair manner, so that most of the groups, if they are ready and they have the capacity to interact and to secure financing from the banks are ready to lend to them. Uh, so as part of this course, I've chosen the prudential regulations related to the corporate commercial banking first, and in the next session, we would try and cover the prudential regulations related to SME financing and project financing. Because I, as a professional accountant, think in terms of being in Pakistan, that we do not deal much with the agriculture financing. and the other areas are mostly related to the consumer financing. So I'd like to stick to the areas where businesses are involved, whether it is big businesses, whether it is businesses who've come to start a big project in the country, or whether it is the SMEs that are the backbone of the economy, and that would be contributing to the growth of the Pakistan's economy if banks were to lend properly to the SME sector. So as part of this series, the first set of PRs that I'm going to brief you about is about corporate commercial banking. In the next session, we'll be covering SME financing and project financing. Feroz, next slide, please. Yeah. Next, please. Yeah. Now, what is the objective of issuing these PRs? Like we've previously mentioned, risk management. That banks are not putting all the risk on one corporate house, on two corporate houses, on three corporate houses. They're spreading their risk. They're diversifying their risk. We are setting boundaries so that banks do not go out of their boundaries. We're looking at the local dynamics. Now, look, the corporate houses in Pakistan are not as mature as corporate houses abroad. If we look at the corporate houses in terms of their corporate governance structure. Now, in a few, a month ago, I had the opportunity to be in a meeting with a big corporate house in the South Punjab region. And as part of that meeting, there was one independent director whom I knew personally outside of that interaction, and I knew his capabilities, and I do believe that a person like him shouldn't have been on that independent board of directors as a non-executive director. So it is the local dynamics. The big corporate houses are not as mature in terms of the corporate governance practices within them. So it is important that the regulator chips in and makes sure that the banks do not put all their risk on few families, rather they spread it out. Now, the purpose of all of these things is to ensure financial stability in the country. Next slide, please, Feroz. Now, the corporate commercial prudential regulations are divided into three different kinds of regulations. The first one is the first few that we cover are related to risk management. The next ones are related to corporate governance. And the last few are related to the operations that the banks carry out. Now, we're not talking about financing here. We are talking about banking here, corporate commercial banking, right? So the banks would be providing banking services to the corporate houses, to the commercial entities. So we need to make sure that when they bank with the commercial or corporate entities, also when they lend to them, they follow these regulations. So the first set of regulations are related to risk management. The second set of regulations are related to what you call as corporate governance. And we as professional accountants are very much aware of what corporate governance is. And the last few regulations are related to operations. Now, I would mainly focus on the first two, risk management and the corporate governance areas. Next slide, please. Now, the first few PRs or the prudential regulations would be related to risk management, and they have been denoted as R. R stands for risk. Next slide, please. Now, R1 and R2, prudential regulation 1 and prudential regulation 2 are related to the exposure limits. How much exposure can a banking institution take against a certain a corporate house or a commercial entity, as we call them? For a single obligor, now obligor is basically somebody who's borrowing money, the borrower. A banking institution cannot lend more than 20% of its equity to a single obligor, to a single group. So if, for example, my equity, if I am a financial institution, I'm a bank, and my equity is 100 million rupees, I cannot lend to a single obligor or a single borrower or a single group, or sorry, a borrower, more than 20%. So I cannot lend more than 20 million. Similarly, if there is a group, like for example, if there's a group of companies, now there is a parent company and then there are subsidiaries. To a group of companies, I cannot lend more than 25% of the equity. Now, where would I take the equity figure? I'll take the equity figure from the audited financial statements. So the maximum exposure limit that a bank can take against a single obligor is 20% of its equity and 25% of its equity if it's lending to a group of companies. Now the next one is the related party exposure limit. Now, for example, like I've previously told you that there is an example where Fatima Group is looking to buy Summit Bank. Now, Fatima Group would become a related party of Summit Bank when it is bought the Summit Bank. So we would need to make sure that Summit Bank is not only lending money to Fatima Group. It starts collecting deposits from the depositors, and it lends all the money to Fatima Group. So we need to make sure that does not happen. I quoted this example. I'm not saying that it is being done. It is only an example, so it should be taken as an example. So related party transactions. Maximum exposure that a bank or a development finance institution can take against a related party transaction is 7.5% to a single related party, or 15% to what you call as if the related party is a group of companies. Now, what are related parties? Like I've said, the companies that are connected to the bank or the employees that are connected to the bank, not the employees, sorry, I just tell you about the related parties. Just give me a second. The related party in respect of banking institutions would be the directors, the CEOs, and any entity that owns more than 5% of the paid up capital of that in that entity. So, for example, if a bank owns 5% of a company or an organization, or has shareholding in that company more than 5%, that would be a related party of that bank. So that is basically what a related party is. So what the regulator has done is it has set limits on the amount of money that a bank can lend to a related party. If it is a single related party, it cannot be more than 7.5% of the paid up capital. And for a group of companies, it cannot be more than 15%. For a large exposure, you know what a large exposure is. Give me a sec. I'll tell you what large exposure is. Large exposure is basically where a bank has lent more than 10% of its equity value to a single obligor or a group. So, for example, if a bank whose equity is 100 million and it has lent about 15 million to a single obligor, now that is a large exposure. In prudential regulations term, we call it a large exposure. Now, at any point in time, large exposure cannot exceed more than 50% of the total gross advances and investments. Now, large exposure cannot include the investments in government securities and the loans that have been given to the government of Pakistan departments, or the government of Pakistan itself, or the guarantees that have been given on behalf of the government of Pakistan. So the large exposure limit cannot be more than 50% of the total advances and investments, but that limit does not include money that has been lent to the government of Pakistan. An exposure against contingent liabilities what a contingent liability is. Contingent liabilities, basically, we are professional accountants and we know, we've read IAS 37 provisions. It tells us that contingent liabilities are liabilities that are payable by the bank and are based on a certain event, on the outcome of a certain event. So it could be litigation, or it could be a lawsuit, or anything of that sort. So it says that contingent liability of a bank should not exceed more than 10 times of its equity. At any point in time, the contingent liabilities of a bank should not exceed more than 10 times of its equity. So, for example, if the equity of a bank was 100 million, its contingent liabilities should not be more than 1,000 million. Now, I'd like to take an input from somebody who would like to add something or ask something here in terms of the exposure limits. Now, the essence of placing these limits is to make sure that banks are not going over and above these limits and are not engaging in practices that would be classed as unethical, or classed as practices that should not be adopted, because those practices would then put the banking institution at risk of failure in the longer run, or even in the shorter run, because if the amount of money that they've lent to a single obligor is more than the limits, and that obligor was to fail, or was to become a bad debt, the bank would have to suffer, and that could lead to a systematic risk. So these were basically the exposure limits. Next slide, please, Feroz. Now, when we as bankers, it's important, we could be working in different capacities, and when we would be lending to a financial group or a big corporate house, it is important that we know how we are going to assess the credit worthiness of that of that organization, or of a group, or a corporate house. So the first and the foremost thing, a part of Regulation 3, is financial analysis. How do we conduct a financial analysis? We as professional accountants, we know that the best thing, or the best document to refer um, um, to conduct a financial analysis of a company is to look at their financial statements. So we would, as a matter of practice, obtain financial statements of different corporate houses who have approached us for financing. Now, it would be important that these financial statements that we obtain are duly audited, and if the borrower is a public limited company, or if the aggregate exposure of that organization or of that corporate house is more than 500 million, where it is borrowed more than 500 million from different banks or different financial institutions, it would be important that we obtain the audited financial statements of that corporate house. These financial statements need to be audited by a QCR rated firm. QCR is basically a rating given by the ICAP. So if a company has borrowed more than 500 millions from say 10 banks, and you are the 11th bank and it has approached you for more funding, I would request that organization to provide me with with audited financial statements that have been audited by a QCR rated firm. If that corporate house refuses to produce audited financial statements by a QCR firm, I would be inclined to plainly refuse further funding to that corporate house. The next thing to check the credit worthiness of that corporate house is that I go through the credit report of that financial of that corporate house. For example, there is an electronic credit information bureau. It is a database that is being maintained by the State Bank of Pakistan. State Bank is basically the custodian of ECIB. It is only a custodian of that database. The entry into this database is being done by different banks. For example, if a company A was to approach Bank of Law for funding, and it managed to secure a funding of 10 million, Bank of Law is bound to report that funding in the ECIB. Now it would report that company A has borrowed 10 million rupees from Bank of Law at a certain date, and then it would keep updating that ECIB and database as and when payments are received, and if there are any defaults, it would also report those defaults or write-offs, so that if that company A was to approach MCB for further financing, MCB would go and fetch a report, credit report from the ECIB database of the State Bank of Pakistan, and use that report to assess credit worthiness of company A. So this part, the regulation 3, where we are conducting financial analysis, we are obtaining audited financial statements, we are obtaining credit information or credit report of the corporate houses. This is basically binding the banks or encouraging the banks to assess the credit worthiness of different organizations who have approached the banks for funding in a prudent manner. Now, another thing that the banks should go through is called as the borrower's basic fact sheet, BBFS, given as part of Annexure 2. Feroz, can we open Annexure 2, please? Now, as part of this fact sheet, banks or the officers who are conducting the credit or assessing the credit worthiness of that potential borrower would be required to take information from that organization on this Annexure 2. Now it has the borrower's profile, it has all the contact information, the addresses, and then it has the details of the directors. Now, details of directors are very important now, because these are the people who are basically running the affairs of the company. Now, if as part of these directors is somebody who is not who has had bad name in the past, can we go to the to number 3, please? Number 3. Now, if that name comes up and I am assessing the credit worthiness of that company that has provided me an Annexure 2, that will be a red light for me. So I would it would be a red alert for me. So I would alert myself and my team to make sure that I'm more careful if I were to make a lending decision to this organization. Next, please, yeah, to number 4. Now it has a corporate status, whether it's a sole proprietor, it's a partnership, or a public limited company. It has details of the management, of the executive and the non-executive directors, uh, the amount of money that they have requested, the amount of fund-based or non-fund-based. Fund-based is basically in the form of funds, in the form of cash, where actual amount of money is transferred to that company. Now we call it as fund-based facility. Non-fund-based facilities where you as a bank is giving a guarantee in place of that company. For example, LC, letter of credit. For example, standby letter of credit. For example, bank guarantee, etc., etc. Next, we have the kind of business that the company is engaged in. Next, please. Existing limits, the amount of money that they have borrowed up to now from different financial institutions. Detail of any write-offs. Detail of any clean facilities that the bank has obtained or that party has obtained. So it is an entire set of information that we as a credit assessing officer would be required to obtain if we are working in a bank. And if we are working in the industry, for example, if I am a professional accountant, I'm an ACCA member working in a big corporate house, I should be ready to give this information in as detailed manner as possible, because the more information that I provide, and the more easier it would be for the banker to reach his or her decision. So this is basically an Excel 2. Now, as part of the risk assessment process, can we go back to the presentation, please, Feroz? So it is a borrower's basic fact sheet that is there. It has got detailed information about what the company is doing, its directors, its what you call as its structure, organizational structure. So it has all the detailed information about the company, which would be useful for an officer who is assessing the credit worthiness of that company to reach a decision about whether to extend finance to that company or not. So R1 and R2, Regulation 1 and Regulation 2, was about limits or the exposure limits that banks could take towards a single obligor or a group obligor or to a large or a related party or against a large exposure. And Regulation 3 is about the kinds of information that bankers would need to go through in order to assess the credit worthiness of a big firm or a corporate or a commercial house that has approached the bank to secure financing. Next slide, please. And the next one is security and margin. Now, it's important as bankers, it is important that the money that we lend to the banks is secured against something or the other. Now, as you would have heard as professional bankers, that um, there is secured lending and then there is unsecured lending, or we call it as clean lending. The exposure that banks can take on account of clean lending is a maximum of 2 million rupees. Anything that goes over and above that has to be covered against a security. Now, there has to be something against which the money that is being lent to a corporate or a commercial house is collateralized. Now, this is basically to a single borrower or a single obligor, the maximum amount of clean lending can be 2 million rupees. And if you were to say extend clean lending to 100 borrowers, that clean lending together should not exceed the equity of the development finance institution. say for example, the equity of the development finance institution is 100 million rupees. It's the lending that is it extends on account of clean lending should not be more than 100 million. Now, whenever you lend to a corporate house, you have to make sure that there is a policy in place where you obtain personal guarantee of the directors of private limited companies. Now, if you're lending to a private limited, it is a corporate house, it's a big corporate house. Its organizational structure is that it is a private limited company, and it would be important that you not only obtain a collateral, but you also obtain, if it is more than the clean lending limit, but you also obtain a personal guarantee of the directors of the private limited company. And also, you would need to assess how good those directors are, what is their experience, how well they've done in business previously. So, because at the end of the day, it is the people who run businesses, it is the people who are running the affairs of the companies. So, it is important not only to look at the financials of the company, but also at the profile of the people who are running that company. Because at the end of the day, if the people who are running those company or that company are not trustworthy, it would not be a prudent decision to lend to that company. So this is basically the amount of clean lending that you can extend, and how you are going to secure your interests in a private limited company where you've lent to a private limited company. That is by obtaining personal guarantees of the directors and by going through the profiles of the directors, their past experiences. Now, one more thing that can be done. For example, if Mr. A came up and said that he is providing personal guarantee for his company, you would not just take his CV to assess how well his financial dealings are, but you would prefer to obtain a credit report of that director as well, to know that his credit report is clean and his financial doings are clean, and he is worthy enough financially that money should be lent to a company that is being directed by him or her. Now come the margin requirements. Banks are free to follow the margin requirements as per their schedule of charges. Now, every year, every bank issues a schedule of charge wherein they include all the charges that they are going to charge from their customers on account of all different kinds of services they provide. Now, they're free to charge any kind of margin that they want. But look, banking industry operates in a very close competition. So, for example, if Bank Alfla was charging 30% and MCB was charging 10%, Bank Alfla would start losing business. So, obviously, a bank can charge margins as per their discretion, but they'd have to stay in competition. So, mostly the spreads that banks charge range about 4 to 5 or 4 to 6% on top of the KIBOR. KIBOR is basically their cost, Karachi Interbank Offered Rate, as we know it. It is the money on it is the amount, it is the rate at which banks offer money to each other. So banks can charge margins when they lend to organizations, as in when they want as much they want, but obviously they would want to stay competitive. But then again, it is these margins are also can also be what you call as a regularized by the state bank or the government of Pakistan. For example, there is this low cost housing scheme where the State Bank of Pakistan, government of Pakistan, in conjunction with the State Bank of Pakistan, ensured that the banks did not charge a margin of more than 4% or 2.5%. So there, the government of Pakistan and the State Bank of Pakistan intervened and restricted the amount of margins that the banks could earn. Similarly, You guys would have heard of a scheme known as Kamyab Jawan scheme. In that scheme, also the margins that the banks are earning have been restricted by the Government of Pakistan and the State Bank of Pakistan. So banks are free to charge as much a margin as they want, but then they would have to stay in competition, and also these margins can be regulated by the Government of Pakistan and by the State Bank of Pakistan. Now, when banks are lending to companies, they would need to make sure that exposure against the shares is not more than 30% of the market value of the shares. So, for example, if a company was securing its debt or providing shares as a collateral, Feroz, I think you've changed the slide. So, for example, if a company was borrowing money and was providing shares as the collateral, banks would need to make sure that they do not finance more than 30% of the market value of those shares. I have mentioned the word margin requirement, but this word would not be included here. It is basically the exposure that banks can take against shares as collateral. So, for example, if the market value of the shares of a company were 100 million rupees, the maximum and the company was offering the shares as a collateral, the maximum financing that the bank can extend to that company cannot be more than 30%, that is 30 million rupees. Next slide, please, Feroz. Now, next comes the monitoring. Now, what you've done is you've limited how much money banks can lend to a particular corporate house or a group of corporate houses or a group of companies. You've also made sure that what you call as just give me a sec. You've also made sure that how are you going to assess the credit worthiness of a company that is approached the bank for financing. Now and you've also made sure how you're going to secure that money. You're going to obtain a collateral. You're going to ensure that you obtain personal guarantees. You're going to ensure that where a personal guarantee is being provided, you obtain the credit report of the directors. You've made sure that the banks are earning money, but the money that they earn is limited. You've made sure that you've put limits on how much money you can lend against a certain amount of collateral. It is different for shares. It is different for a residential property. It is different for a commercial property. So in normal circumstances, the maximum amount of money that banks can lend against a residential property is equal to about 65 to 70% of the value of that property. Similarly, the maximum amount of money that banks can lend against shares as a collateral is 30% of the market value of those shares. So up to now, we've seen that the prudential regulations have limited banks in terms of the amount of money that they lend to a certain group or a group of companies or an individual or a single company. We've seen how the banks are required to assess credit worthiness and to safeguard the interest of the bank. We've made sure that they are obtaining enough security. They are collateralizing the loans. They're securing the loan. They're securing the loan appropriately. And just give me a second. So they're securing the loan and they're earning margins. Now we come to the point where we are trying to we are trying to regulate the banks, or we are trying to encourage the banks that not only do they obtain the collateral from the borrowers, but they also monitor those collaterals. Now, why is monitoring a collateral important? Now, look, when you enter into lending to a corporate or a commercial entity, the corporate and commercial entities are into different kinds of businesses. Not all corporate and commercial entities have commercial and residential properties at their disposal that they can provide as collateral to the banks. For example, if a business is engaged in trade of rice, that business would have large amounts of uh, inventory in the form of rice. Similarly, if a business was engaged in the business of sugar, for example, sugar mills, they would have access to a large stocks of sugar. And same amount comes with a business that is engaged in the business of cotton, or so on and so forth. So it would be important that banks have a mechanism in place where they can check or monitor the position of the collateral, because at the end of the day, it is the collateral that is going to secure the loan of the bank if that corporate entity was to default. Therefore, collateral management is an entire process or is an entire art that needs to be established within an organization. The prudential regulations require that every bank has a duly approved collateral management policy. This collateral management policy needs to be approved by the board of directors. Now, this policy can be an extensive document. It can cover different aspects in terms of the kinds of collaterals that are acceptable to a bank. For example, a bank may be accepting residential property as a collateral, and the other bank may not be accepting it as a collateral. Now, this is a matter of policy, because one bank has made it a policy that it would accept residential property as a collateral, and the other has formulated a collateral management policy where it has said that it would not accept a residential property as a collateral. So these policies can vary from bank to bank. But some of the important ingredients that this collateral management policy should have is that the kinds of collateral that you accept, it needs to be, its quality should be good. How should its quality be good? That it should be available, it should be accessible, it should not be at a position where, it should not be located at a point where where the bank cannot access it. For example, if a residential property has been given as a collateral and it is located in a disputed territory, then it would not be advisable to accept that residential property or a commercial property as a collateral. So quality is important. A disputed property or a property located in a disputed territory is not of good quality. Similarly, the valuation at the time of granting the loan or at the time of assessing the loan is enough to cover the loan being asked for. And then the collateral is in a position that it can be readily converted or it can be sold, where the legal rights rest with the owner, and it is not in any kind of a legal dispute or a litigation. Now, the quality, as I've said, management is an entire process. It lasts from the very outset to the end of the loan. For example, you've accepted a collateral as a qualitative collateral at the time of granting the loan, but eventually you find out that that property has come into litigation or has come under some sort of a dispute. then next time when that borrower would come for an extension of a financial facility, you would advise that organization to replace that collateral. So not only do you obtain a collateral of good quality at the time of granting loan, but also at the time of extending that facility or halfway through that facility. Similarly, now this is for a collateral where the collateral is in the form of a property. Now, if a collateral was in the form of stock, it would be important for you to conduct inspections of that pledged stock. Now, those inspections would have to be conducted in the form of a joint inspection where the representative of the bank, a third party represented by the bank and the party are available, and the pledged stock is monitored, that particular stock is available at the premises and has not been sold on. They should be done at least once in a quarter. So, for example, if there is cotton, now there are aggregate limits how much exposure you can take against a particular commodity. Against cotton or putti, as you call it in Punjabi, the maximum exposure that a bank can take is 500 million. Against sugar, it's 500 million. Wheat is 250 million. Rice is 150 million. And edible oil is 250 million. Next slide, please, Firoz. Now, the last few regulations with regards to how a bank has to lend are related to the exposure that the banks can take in companies, in the shares of a company, or a sukuk. Sukuk is basically an Islamic instrument, financial instrument. So the maximum exposure that you can take in corporations in terms of buying their shares, it is important that we limit banks in terms of that as well. Now, lending is something else, but buying shares is another thing. Buying shares is another way of financing that company. Although by buying shares, banks are trying to invest their money, but when they invest their money, they're basically investing money of the depositors. So the role of the regulator here is very important to safeguard the interest of the depositors. So the maximum amount of shares that they can own in any firm cannot be more than 5% of their own equity. For example, if there was an equity of 100 million of, say, Bank A, that bank cannot own more than 5% shares of a single company. When the bank is looking to own more than 5%, it would require regulatory approval from the regulator. Now, guarantees, like we've spoken about non-funded borrowings. Non-funded borrowings are where the bank is acting as a guarantor. Actual money is not passing on, is not being paid, but the bank is basically acting as a guarantor. For example, in case of a letter of credit, for example, in case of a bank guarantee. In these cases, it is important that all the kinds of guarantees that a bank issues, they are secured, and the credit worthiness of that institution or that company for which the bank guarantee is being issued is considered. Where a bank guarantee has been issued and the party defaults, for example, in case of LC, the party does not pay up or disappears all of a sudden, it is important for the bank that such a case should be reported to the State Bank of Pakistan. Because in case of LC, if LC was to default, the bank has to pay in place of the party because bank is a party to the LC. So in such a case, the case needs to be reported to the authority, to the regulator, so that the regulator can continue or can start proceedings against the delinquent company as per rules. So up to now, what we've done is we've made sure that banks do not lend above certain limits. We've made sure that they assess the credit worthiness in a prudent manner. We've made sure that they secure their interests. We've made sure that they earn margins in a competitive environment, and also there may be limit as and when needed by the regulator. We've made sure that they obtain collateral, and those collaterals are monitored from the very start to the end. We've made sure that those collaterals are inspected on a quarterly basis by all the parties involved. We've made sure that exposures that banks takes in terms of shareholdings are not above a certain limit. We've made sure that all the guarantees um, are secured, and where guarantees are breached, they are reported to the regulator so that action can be taken. Next slide, please, Feroz. And this one is very important: classification and provisioning of for assets. Now, this is where you're basically trying to make sure that banks are provisioning their non-performing loans, NPLs we call them, non-performing loans, in a prudent manner. And those NPLs are showing on the books of the financial institutions in an appropriate manner. And banks do not go overboard in declaring their NPLs. So the classification of these NPLs is very important. This has been included in Annexure 4 by the State Bank of Pakistan. I would request Feroz to open Annexure 4, please. So this is Annexure 5. I've incorrectly titled it as Annexure 4. Now, this is a document that shows when you have to classify your loan as a substandard loan, when you have to classify it as a doubtful loan, and when you have to classify it as a loss. Where markup interest or principal is overdue by 90 days, you would start classifying this as a substandard loan, and you would provide a provision of 25% against that loan. Provision of 25%. Where markup or interest or principal is overdue by 180 days, you provision 50% of the difference resulting from the outstanding balance. So provision amount is 25%. In this case, it is 50%. Where markup, interest, or principal is overdue by 1 year or more, that is only when you provision 100% of the difference resulting from what you call as where interest has not been paid for more than a year. So now where a loan has been where we started, the prudential regulation started from making sure that how the money was being lent, how it was being handled, how it was being secured. Now we've come to the point where the loan would convert into a loan. We need to make sure that the bank declares these losses in an appropriate manner. Where it is substandard, 25%. Where it is doubtful, 50%. And where it is a loss, 100%. Next slide, please, Feroz. The last one is the payment of dividend. Now see, we call it corporate commercial because the bank is not only lending to the corporate commercial, but a corporate commercial might have invested in that bank as well. The corporate commercial might have invested in that bank as well, yeah. So we need to make sure that the money that the bank is paying as a dividend to those shareholders is only paid as a dividend when the bank has met its uh, minimum capital requirement. So it has met its minimum capital requirement, and all its assets have been classified fully and duly provided in accordance with the PRs. The classification, as we've mentioned in the previous R8, the provisioning and the classification of assets. After that, if any money is left, or if there is any room, then only the bank would pay dividend to its shareholders. For example, in case of Summit Bank, if Fatima Group was to take over Summit Bank, and Summit Bank was to pay dividends to Fatima Group, it would first need to make sure that its MCR and CAR minimum capital requirements and capital adequacy ratio requirement is met, and all its provisions have been classified appropriately. Then only, if it has money available or if it has funds available, it would pay as a dividend to its shareholders. Now we go on to corporate governance. We'll start from corporate governance in our next session. I try and be more fast when we start the next session in our next session. Now, I will try and address a few questions. I'd sum it up the entire thing that we've done today. Pakistan's banking regulation is based on Basel III. State Bank regulates the banking industry. State Bank regulates the banking industry. It issues PRs. Today's PRs that we've studied are related to corporate commercial loans. In this session, we read about the exposure limits that we can take against different companies. How are we going to assess credit worthiness of companies? How are we going to make sure that our loans are secured? How are we going to make sure that yes, I'll come to the questions now. The first question is, what exposure for government financing, like export refinance? Now, the refinance schemes are basically financed by the State Bank of Pakistan. The money involved in, for example, LTFF, long-term financing facility, is basically the money of the State Bank of Pakistan or the government of Pakistan. So that is not the bank's money. So the exposure limits do not consider the money lent under different refinance schemes or under different government schemes. So that is out of the exposure limits. Now the next question is, I have not been able to understand exactly the point 1 and point 2 here, since I part of 7.5%, whereas single obligor percentage is 7.5% is for a related party. 7.5% limit is for a related party transaction where you're lending to a related party. 20% is for any party. It may not be a related party. If Summit Bank was to lend to fertilizer, it cannot lend more than 77.5% of its what you call as its equity. But if it was to lend to, say, Toyota, it can lend up to 20%. what is the difference between margin and lien? Margin is basically the money that the bank is earning. That is the bank's margin. So like I said, if the deposit are costing 10% to the bank and the bank is lending at 15%, the spread is basically the bank's margin. Lien is basically you're marking your lien on a particular asset. For example, if a company A borrowed 100 million and it provided as a collateral an asset, now the bank would mark its lien against that asset in the land record uh, uh, authority. So when the bank would have marked its lien, that party would not be able to sell that asset onwards until that lien has been unmarked. So lien marking is different from margin earning. Margin is basically what the bank is earning, and lien marking is basically you putting your lien, you're putting your lien in the record so that that asset cannot be sold on. No, they're for the bank as a whole. For the pledging of the stock, they're for the bank as a whole. Yeah. Like for pledging stock, the limits you're showing are for an individual entity or for a bank as a whole. They're for a bank as a whole. Sorry, let me go through it again. Yeah, just give me a second. They'd be for one single entity. Sorry, I'd correct myself. Muhammad Fahim Islam is offline right now. That'd be for a single entity. The maximum that you can expose yourself against those stock types, those are the limits for a single entity. Next, please. Any more questions to this? Raj and lien, they go hand in hand. These are the words used interchangeably. They are the words used interchangeably, so they you can say that they are one and the same thing. So I think we've taken enough questions, and we've come to a close. In our next session, we'll be covering prudential regulations related to SME. We'll cover the corporate governance portion of this PR, and we cover PRs related to SME financing and project financing. Now I'd hand it over to Mr. Feroz for his remarks, please.